What's going on, everybody, and welcome back to another episode of the Get Over Yourself podcast. I'm joined today virtually by Andrew Chen. I started seeing Andrew's content online, I don't know, Andrew, probably a month or two ago, and I've loved it. It's a younger guy in the venture capital world who's diving into a different form of content that most VC firms are very outdated on. He's posting on LinkedIn, X, Instagram, TikTok, kind of untraditional avenues that are starting to become a little bit more mainstream for venture. But Andrew, your kind of words and encouragement and advice, it was duly noted inside the back of my head. And so now we're launching a series where I interview different VCs throughout the country to learn their investment thesis and kind of what they're looking for in founders, what their red flags are, and kind of where the entire venture scene is going in this age of AI that we're living in. So, quick note on Andrew. He's a scientist turned venture capitalist who is focused on investing in real technology that still solves real problems for real people, specifically at the pre seed and seed level. Andrew prioritizes investments in the evolution of energy, future of manufacturing, and core American necessities. Andrew, welcome to the podcast, and let's jump into today's episode. Absolutely. I guess I want to jump kind of earlier stage. What your background is, kind of going all the way back into college, because I feel like getting to know you a little bit. That's kind of what got your journey going. Before we do, though, I'm curious. As I mentioned in the intro, you're doing some content strategies that are a little outside the norm of most VCs. It's becoming a little bit more normal. You see it popping up, but why your interest in getting your name out there on Instagram and TikTok and things like that?
Yeah, it's interesting. I think broadly speaking, like venture capital is moving into a very new era, and I think we're going to talk about this more a bit later. But you're seeing this world where you have 10 funds controlling 80% of the capital stack, which is wild. I mean, it's just incredibly concentrated. And so if you're in a position like myself, where you're building a venture capital firm, where you're an emerging manager, you really have to find ways to stand out, to resonate with founders, and to have a right to win deals. For me, a lot of that has been community building trust with people before they get on that first call with me. I think a very easy way to do that is through media, through posting your actual opinions, through posting a very unfiltered, like I am very unfiltered on social media, for better or for worse, and a very unfiltered version of myself and who I am. That allows people to have an understanding of if they are the sort of founders that would want to work with me, if we're overlapped in that capacity. It makes it much easier when you get in that room on that call to win deals, to find the right people that you're looking for. And also, frankly speaking, to just like provide a lot of good to the ecosystem. Like I started posting on TikTok about a year ago, and frankly, most of the reason why is I just saw a bunch of either junior VCs or other emerging managers who didn't really have that much experience giving incredibly terrible advice. And I felt like I had at least a need to guide people in the right direction, because just because a founder doesn't necessarily have a deep Silicon Valley experience, deep network, doesn't mean that they're not building something incredible. And if they get steered down the wrong path by somebody online, then you'll see a couple of great technologies really fall through the cracks. And then it's just transformed from there, man.
Absolutely. No, I love it. Let's jump back for a few minutes and talk about your early days. It's
Yeah.
interesting. In your bio here, I was reading off, you're going after the energy, manufacturing, and core American necessities. And I
Yep.
feel like that's a sector, maybe it'll become a little bit more popular over the next few years, but it's definitely the unsexy areas in venture right now. I feel like a lot of that roots back all the way back to your college days and kind of your background and what you studied. Let's do a dive into that.
Yeah, I mean, if I'm being wholly honest, you can backtrack this even further. My grandparents on my mom's side are from Northeast Tennessee in Mountain City. It's a town of 2,500 people. So I used to spend my summers out there, and you get an appreciation for the fact that, yes, you might live in a city. I grew up in Denver, also not a really big city. But there's a lot of life and a lot of people operating in a very different way outside. So when I went to college, my degree is in geophysics and English literature, the English part of that being obviously a little bit less important. But I'd always wanted to work on just things that were very tangible. That's where my interest in like mining came from. That's where the geophysics degree plays in there. I always thought I was going to be out on a mine site. When I graduated, there were not a lot of jobs out on a mine site. And so I ended up working at NASA's Jet Propulsion Lab doing planetary interiors and geophysics research. And it really never meant to be in venture, but when I was doing research, I just found that like I didn't feel like I was making an impact on anyone, and that's where it goes back to that story. Is it's like what is my research on Europa Clipper doing for my grandparents in Tennessee, my cousins, my uncles? Like, is that something that they will ever care about or ever be able to touch? And it's like not really. So I've been looking for other jobs. My roommate came in one day. He's like, "Hey, Andrew," it's like, "All right, dude, you've got to apply for this venture capital thing. This woman's interviewing everyone from Caltech who applies." Sorry. Like, I don't know the first thing about venture capital. Like, dude, just Google it. You'll be fine. So I Googled it. Turns out in a venture capital interview, they don't actually ask you anything about venture capital. They just said, "What technology are you interested in?" I said, I'm a mining guy. I have a degree in geophysics. I said, "Lunar mining." Instantly made it through to the next round. This is like 2019. Everyone was really excited about mining. Then they have me pitch a company. I pitch deep sea mining company. They're like, "Great, you're getting brought on 10 hours a week to focus on mining." Um, Ended up sourcing a couple deals for the firm, got brought on full time. After you get brought on full time, you realize mining is not really quite enough of a niche to build a whole career around. I still think I'm one of the better experts in that space from a venture side, but I started expanding into adjacent industries. Again, this concept of core American industries. So agriculture, construction, manufacturing,
Mhm.
uh, more downstream energy, so grid, power utility. And that's what I built most of my career around is applied robotics, complex AI, a little bit of biotech, although I haven't done a deal there in a hot minute. And yeah, so when I went to Builders, that's what I was doing. And then now that I've left Builders, it's still what I'm doing.
That's excellent. I want to jump back for a second. You mentioned
Yeah.
that the career trajectory you were on, it wasn't necessarily something that was, I don't know if you're trying to go off the frame of satisfy others or it just wasn't necessarily as important when you're doing research, but you specifically
Yeah.
mentioned that it wasn't making a direct impact on your family, your grandparents. What does that mean? Or is it
Yeah.
something that you just take a lot of pride in
No, I
or
mean,
walk me
I
through
think
that?
like, look, when you're a human, I think you like to think about your place in the world, or at least I think about my place in the world a lot. And
Mm.
I'm not a super religious person or anything, but and so I'm not really sure life has that much meaning versus you leaving the world in a much better place than when you got into it. And I felt like I certainly wasn't doing that at JPL. I mean, look, I loved working there. I think it's a great organization. They do a lot of really good science. But at the end of the day, I was like thinking about like my research. I spent a year on a project that produced software that's used occasionally by 3 people in China. And I know this because they still send me emails about this sometimes. I'm like, guys, it's been like 6 years. Come on, I'm not maintaining your Python package for you. You can update the GitHub. Like it's open source. But it felt very like trivial in the grand scheme of things. Not that venture always is a sort of like it's not an impact industry, but at least you feel like you're really doing something, and that you're in the mix of technologies that are transforming the world one way or another. I think that's why venture is very attractive to me and very tangible in that sense.
I think venture could be more impactful. I understand it's kind of
Mm,
the double edged sword where you're getting the capital from your investors and going, but I mean it's changing lives in a plethora of ways, not just for you and your investors, but also for the companies that you're backing, especially in your space. In theory, you're backing companies that are going to revolutionize these different core American necessities, as you call them.
yeah.
So I don't know, give
Well,
yourself a
I
pat
mean,
on the
I'd
back.
say venture could be more impactful, but then I'm like looking, I read this headline. It's like, oh, OpenAI raises $110 billion. I'm like, that's money that like
But
there's some of these
let's
crazy
dive into
rounds
that a
where you're
little
like,
bit.
yeah,
Yeah,
what do you
there are
want to
some
dive
crazy
into?
rounds, and yeah, I mean there are some crazy rounds going on, and obviously you're always going to read the headlines of the sour apples and the bad grapes. But what's your thesis on the VC landscape right now? It seems like, as you mentioned earlier, the top 10 firms are controlling a lot of the deals, and they have their hand in every single cookie jar. It seems like. What's the landscape
Yep.
from the VC perspective right now?
Well, so I mean, I think that's one main dynamic. I think the other is that there was a whole wave of people who really should have been washed out post like 2021. there was, oh my god, like just a stream of really bad investments that came out of that era at ridiculous valuations. Normally, what you would expect to see is like after that wave of hype, the post-COVID zero interest rate wears off, that the people who didn't really deserve to raise funds and didn't know how to manage capital effectively get washed out of venture. They don't have returns. However, then AI came in and sort of kept everyone going for a little bit. Uh,
Mhm.
and I mean that to say a little bit. I think you're starting to see now that there are a number of zombie funds, people who haven't written checks in 12 months, people who aren't able to raise their next fund. You're starting to see that, but that should have played out a couple of years ago. It means there's still a lot of competition for rounds. Prices are a lot higher than they should be. And there's also just like, for lack of a better way of putting it, like a lot of dumb money in the venture ecosystem. Um, it's not that like I necessarily believe that I'm strictly smart money. I do know not to back things that are scientifically infeasible. And I've seen enough of those companies get backed in the last couple of years that you're like, really, like, come on, like, guys, you can do the basic physics. Like, it's back in napkin math to know that that's not going to work out. Um, and that means that that capital is getting diverted from places where it actually could make an impact. It's getting diverted from a lot of founders who don't fit the Silicon Valley profile, and it's just getting pumped into these things that like look like good investments. It's your Stanford dropout or whatever because they've got the right pedigree, but it's not actually a good investment under the hood.
Mhm. Walk me through that. Why is so much capital being allocated to, especially in your space, these projects and these ideas and these companies that, theoretically speaking, it's impossible to go, at least in the time that we live in, right?
Yeah, I mean, look, I think it's because ventures never really had a lot of substance, and that was something that really shocked me when I joined the industry, is that most of these people come from very strictly business backgrounds. They have a very little technical understanding, which means
Mhm.
that they're biased towards a sales mentality in venture, which means you're doing deals in order to raise capital. I think that's one issue. It's like I have TikTok coming out on this in a couple of days on like the 2 and 20, and that you're paid a management fee no matter how much you return. So you're incentivized to just keep raising funds and to do deals to raise funds. That means you do deals for the story, not necessarily because they have any real value to you or anything like that, right? But I think the other part of this that's going to play in here pretty quickly is that, look, um, if you don't have an understanding that you're backing fraudulent technology, but you want to seem smart, you're just going to back tech without actually doing diligence. You have to move quickly. Competitive markets also drive that too. All the above,
Mhm.
man. It's a lot of dynamics, but like one of my long-term theses is that we should have more scientists actually allocating venture dollars. The issue is you have to teach the scientists sales. It's much easier to have a salesperson to start than you just back bad companies and collect management fees.
Mhm. No, definitely. Dive in a little bit deeper. I know you're releasing TikTok. This episode won't come out for a few weeks, so the sauce will already be spilled online. Let's dive back into this thesis of yours of this management fee.
Yeah, so okay. Well, look, in venture, you're paid on a 2 and 20, right? Which is you get a 2% management fee just on your capital under management and 20% on whatever upside you're paid. If you're Andreessen Horowitz and you're able to raise a $4 billion fund, let's call it, and that's like on the smaller end of some of their capital, that means you're rolling in, $4 billion fund. That's 80 million a year in management fees. It's a lot of money, and you really don't have that much incentive for performance because again, you can also then make a 2x on that fund and you get 20% of an extra 4 billion. So you're netting, close to $500 million for not really doing that well. What's the incentive for you to put in a ton of effort versus making sure you raise that next fund to net another $500 million for not doing that well? Um, I think realistically, one of my life beliefs is that at some point in time we have to switch to a model that is management fee by LPAC election. So basically, you're only paid based on like a budget that you propose and saying, okay, the novel idea, we're going to propose salaries that are, good salaries. Like you can pay a general partner 400K a year, right? Like you can pay a general partner 500K a year. That's a good salary. But that your incentives have to come from the carry, add in a hurdle rate in the carry, and then you balance that out and like, keep VCs incentivized by saying, okay, look, you perform over a 3x, that 20 becomes a 25 or a 30. You perform over a 5x, you get 50% of anything over a
Mhm.
5x, right? And that's a much more incentive aligned model where LPs then get performance. VCs actually have to work for a living. There are jokes that you'll see over the internet everywhere about like VCs taking the summer off on Europe. Like, they're not really jokes. Like, the number of times I've like sent emails and it's bounced and been like, yeah, I'll be back in office in like 2 months. Like, what? It's not how life works, man. Like, if you're not grinding it out, you're not going to generate returns. So
Why do you
that's
think
what it is in there.
why do you think the VC route has gone down that path over the past few years? And do you see that more concentrated at the top tier firms, or do you think that also trickles down to smaller, newer funds as well?
I mean, it's really easy to get lazy in venture once you've closed your first couple funds. All this comes from the LP side, and really more than anything, if you're going to blame anyone in this ecosystem, it's your institutional LPs. There's like the old quote, like you're never going to get fired for buying Intel, right? Like, you're not going to, same deal. You're not going to get fired for investing in Sequoia. You're not going to get
Mhm.
fired for investing in Andreessen. It's an easy way out. People don't want to put their careers on the line. Frankly, at institutional firms, like if you go to CalPERS, it's not like you're paid that well to work at CalPERS. You have a lot of power, but you're not really paid that well.
Mhm.
And so there's very little incentive for you to take risks to actually do good deals again versus like, and it's a small part of your book. Like, your private equity allocation broadly for an LP like that's going to be pretty small. Your venture allocation's even smaller within that. Like, no reason to rock the boat on a small allocation. I think you basically have to demonstrate to LPs at some point down the line that, a different model generates higher returns, um, and be very aggressive about marketing that. That said, it's like, look, I think if I'm able to accomplish that in my career, if I'm able to build from, fund one to fund five or whatever, fund seven, and say the structure is why I'm successful, maybe you'll shift 10% of institutional LPs. It's a lot of capital. I think that's a good mission for a career, but that's not like you maybe shift 10%. It's being realistic. Like, the industry doesn't change.
So is that your goal on why you kind of shifted out and started Addis, or let's dive into your firm specifically
Yeah.
and what your goals are?
So the reason I decided to build Atas, so I was looking a lot. So when I left Builders, I was originally just taking some time off to do a family. Had been doing consulting through Viridian, so just like software custom AI build outs for other VCs through family offices. And I got to a point where my family's health, my dad was doing a lot better, and I was deciding really whether or not I wanted to go to another firm, whether I wanted to start my own thing. Ran an exploratory process. I think trust is something in venture that I have a great appreciation for. The firm I used to work for, Builders, was a descendant of Formation 8. If that's not something you're familiar with, you can read about it online and understand partially why I value trust so heavily. It's long-term partnerships in venture, and there just wasn't anyone I really trusted at that level. I think my focus is pretty niche. There aren't a lot of firms that do things in the space. And I had a steady income coming in from consulting, and so I said, look, I'm still in my 20s. I'm single, wildly, to your point earlier. But I've got a couple of years ahead of me where I can grind without really worrying about, family commitments, obligations. This is probably one of the last times in my life where I will have that flexibility. If there's a time to go start my own thing, to build something, to try to optimize for that outcome and that long term, now's the time.
And what was the transition like? I don't know your technical role
Yeah.
in your prior firms that you were working at, but what was the transition from a larger group like that to kind of going out on your own, raising a fund?
Yeah.
Walk me through that a
So
little
I'm
bit.
gonna play around this a little bit carefully because of general solicitation. So at Builders, I was in a bit of a dual chief of staff principal role. My title's investor. I was sitting on 10 board seats between observer and director roles. Was helping a lot with fundraising. Led, I think my name's on like half the term sheets they issued over the last year I was there, and negotiated all those rounds. But that role is very different. Builders, our fund was 250. We were managing about 500. Going from that to building your own firm at a much smaller size, right,
Mhm.
is going to be different. You're shifting LP types is the main thing. So you're shifting from institutional LPs who run very distinct processes with 90-page due diligence questionnaires to going and like, you know, meeting this random guy at a karaoke bar on a Thursday night. Uh,
A
I
little
think that
different, just
process
a
is
little bit.
super different. So even not having a support structure, like I had an EA at Builders, that was super helpful. I was able to replace a lot of that by coding. That's been one of the wonderful things about Claude and the era of AI we're in is like I've been able to code my way around a lot of the resources I no longer have. I have an AI executive assistant now that's like it's not as good, but it's like it gets like 70 or 80% of the way there. And so, not having the support infrastructure and then frankly not having a team either, like even just for morale, like I loved working with my office mates like Jeff, who's our CFO of Builders, Johnny, like I love those guys. And it's very different, being able to rely on others in that sense too. I think it's a very lonely path to build your own thing, especially as a solo GP. Um, doesn't mean it's a bad path. It's just you have to be very comfortable with yourself at some point.
Yeah. Yeah, I can imagine that road just like any. I mean, it's a different form of startup, and it can get lonely and grueling, and there's a lot of highs and there's a heck of a lot of lows. That's for sure. What
Yeah.
what are some of the biggest lessons you've learned as you've kind of started venturing out on your own, and what would you caution if somebody was trying to jump into a similar boat? I want to hear this from both
Yeah.
the VC perspective and from the founder perspective.
From a VC side, yeah, I'd say the first thing that I usually ask other emerging managers and we chat is like, why are you building your own firm versus just running AngelList deals or syndicating deals? I found very few people have an answer for that. For me, it's around that long-term optimization on saying like, look, I'm building something that's going to be generational here. Most people I meet as emerging managers, like, I just want to try out this VC thing. I'm like, great, build a syndicate. It's much easier,
Hmm.
much less of a headache from a legal side, much less risk to you, much yeah, that I don't know, like where I had thoughts about doing that at some point, and I said, no, look, if I'm going to do this like a firm, I'm going to build a firm. I'm going to portfolio construct like I'm a multi-billion-dollar organization. I'm going to run this like a multi-billion-dollar organization, and the idea is
Hmm.
that sometime at some point you get there. That's why you just say on the VC side. I'd also say this job's not easy. I do see a lot of people try to jump into VC without having actual investment experience until you've had to sit down and tell a founder that you're liquidating their company. I would not go out on your own and try to build your own firm because there are a lot of tough parts to this job that you are not going to see as an angel investor. You're not going to see, uh, you know, as an entrepreneur. Not to say that you can't become a good VC if you're an entrepreneur, but like there is real lived experience that goes into working for a firm. So that's like my little rant there. I do see a lot of people being like, "Oh, I should just start a VC firm," and then like it's even if you can raise the money, deploying it, managing it effectively is a whole other can of worms.
Hmm.
On a founder side, I mean, I think you have to see. There's this quote, and every now and then I'm on TikTok a lot, right? There's this quote that is like, you have to be willing to sprint when the distance is unknown. If you're not willing to do that for your problem as a founder, if you're not willing to put in those hours, get close to bankruptcy, fight through every fire, co-founder disputes, breakups, if that's not worth it to you, you shouldn't be founding that business. There's no like there are people who have easy roads to founding companies. For the most part, there's no such thing as an easy road to founding a company. It is hard. It will chew you up. It'll test every limit. I think it's incredibly rewarding, both on my side for building a venture firm, and for the entrepreneurs I work with. I think all of them would rather be doing this than anything else. But like, you have to be willing to put in that effort and to know that you're in it for the long haul.
It's kind of interesting. Ever since I started Interval, I have this like naive perspective, and I have conversations all the time where I realize that it is completely just inside of my head. And I think,
Yep.
man, being an entrepreneur is probably like the greatest thing I could ever wish upon anyone. And I get this naive sense in my head, and I go, I don't understand why anyone doesn't go out and do this. And then I go through, that one, you ride the highest of highs, and then you go and you hit those crashes, the
Yeah.
lows, and you go, yep, that's why it's not built for everyone, and why it takes a special kind of idiot sometimes to go out and actually found their own company. It takes a lot of different different factors. But yeah, I think the biggest one in there is a sense of optimism and mixed with craziness. But
Yeah,
walk me through on
craziness.
your
Yeah,
investment thesis. Yes, definitely craziness.
yeah,
But walk me through on your side your investment thesis. What do you look for specifically in founders, both on the
yep.
positive, the green flags, and the red flags?
Yeah, so I'd say I have a pretty strict investment mandate, and that's something that like people don't necessarily appreciate when like I'm on TikTok talking about this. I invest in things with a level of technology defensibility. That's the real tech angle. For me, that means you have to have robotics, you have to have some type of integrated hardware, or you have to have a software stack that's complex enough that I don't think I could replicate it in a year of time, which is like it's a
Mhm.
pretty decent bar. I code a lot. I do AI consulting for people. It usually means you have a team of ML engineers, scientists working on the back end to actually develop novel models alongside a proprietary data mode. So like that's the first barrier, and then I want to be affecting real people, right? So agriculture, energy, manufacturing are the three main pillars. I'll touch a lot of other stuff outside of that, but it's like very tangible, real industry. Part of that's because these are sectors that have been historically underinvested in venture capital.
Mhm.
The other is that it's like very macro resistant. We're recording this days after the Iran attacks. Putting politics aside, the U.S. government's going to do whatever the U.S. government does, no matter who's in office. As a venture capitalist, your job is to optimize for a 10-year outlook. That probably means you're going to see 2 or 3 administrations at a minimum
Mhm.
during that time. Macro is going to change. Macro is going to shift. Any pandemic, you want to be resistant to another pandemic if that comes up. No matter what happens in Iran, no matter what happens with China, no matter what happens with U.S. nuclear development and like reshoring, people are still going to need to eat. People are still going to be using the grid for power. People are still going to be building homes. You know, you're still going to be manufacturing cars. All of these are sectors that are very macro resistant. And I'll even tell people it's like, look, I'm not going to try to ride a hype wave and make a 70x on this fund. What I'm optimizing for is real returns, tax advantaged, you know, and a macro resistant way that's like, it's weirdly contrarian right now. Which means, who knows, maybe there is a chance that this will swing back into vogue and I'll hit a 70x,
Mhm.
right? But like, you never know. I would say this is a sectors I believe in, technologies I believe in. And then there's that aspect of, it solves problems for real people. It's like one of the trends I hated the most during my venture career was when we were doing 15-minute grocery delivery. I was like, come on, like, who needs 15-minute grocery delivery? I can wait a day for my groceries. Like that's a problem that 1,000 people in San Francisco have. And yes, those people control some amount of money, but like that's not the sort of thing like if I try to explain that to my grandparents, it's like they're gonna be like, what the hell? Like, why would you do that?
Mhm.
That's frivolous, it's silly, it's wasteful. And I find that's a lot of what you'll see in Silicon Valley falls into that category.
So is that kind of the area of founder that you look for as well as somebody who kind of lives in more of a sense of reality? Or walk me through the red flags now. Walk me through the things that if you're looking at a deal and you see a founder, what are the biggest red flags
Yeah.
that come across your plate?
Oh man. Okay. Biggest red flag is anyone who lies about anything. Um, Been through too many dicey situations. If you misrepresent facts, if you're not transparent, that's an instant no for me.
Mhm.
Um, Number two, and is like as much as I hate to say this, like it's fundraising and fundraising ability. This goes on the green flag side too. You have to be able to raise capital. It means you have to at least have an understanding of how to pitch. You have to be decently engaging. And realistically, I think there are a lot of people who should be CTOs of their own company and aren't willing to admit that because the CEO title is that appealing, especially in
Mhm.
the areas I invest in. Like I see it all the time with robotics companies. I see it all the time on the complex AI side. You should be a CTO or a CSO, not the CEO.
Mhm.
Um, and so that's it's a red flag. Oh man, I
Dive
mean,
into
I
that
invest in
one
the
real quick.
pre-seed. It's like,
I want
yeah,
to I want
yeah.
to hear that one a little bit more. Dive into that. Why would you counsel somebody against being the quote unquote CEO in some cases?
I mean, it's like you have to know what your skills and abilities are and what you're suited to. A CEO's job, as at least as I break it down and as I've seen it throughout my career, it's fundraising and hiring. You need to be able to raise capital and you need to be able to hire and inspire the best talent to work with you. If you're not a super charismatic person, if you've been in a lab for the last 10 years, doesn't mean you can't necessarily do that. I
Mm-hmm.
believe that you can teach this too, but if you are dogmatic about staying as a CEO when you should not necessarily be the CEO, it's a problem. And I've seen that play out a couple times when, some of the best CEOs I know were willing to do it through the pre-seed and they step off after they raise the seed round and hand those reins over to someone else. Um, I think you get more lenience on basically all red flags at a pre-seed. You're investing at a lower valuation, and that comes with you being willing to take more risk and being willing
Mm-hmm.
to underwrite a lot of hair on a deal. There's no such thing as a perfect deal. You're always underwriting something. So, but there are like the fundraising side, especially, is like if you can't show to me that you know how to run a venture fundraising process, that you know how to build a pitch deck, you know how to talk with investors and hold a conversation, you know how to keep your cool. Like I'll test people on pitch calls. I'll drill in pretty hard to questions and get into the weeds of them. And if they crack, if they start reacting aggressively towards me, then I know it's a pass.
Mm-hmm. That makes perfect sense. Speaking of valuations, obviously, if you're diving in the pre-seed seed
Yeah,
stage like you are, and your fund is, that comes with a completely different investment thesis than companies investing in the Series A and beyond. What do you look for specifically in those rounds? It seems like valuations are starting to shoot up for the pre-seed and seed. Now
yeah,
it's kind of an arbitrary term. Every single day in the news, I read of like some former like deep researcher at Meta or Google or one of these top tier companies, and they go out and spin off some AI research lab or something along those lines and raise a $400 million seed round or with these
yeah.
crazy valuations. What do you think about that entire landscape that is popping up more frequently?
Yeah, I mean, look, at the end of the day, valuations, round names, they're all made up. Everything's made up in venture. It's for me when I evaluate this, is I look and I say, okay, what's my expected value on this investment? What are the risk profiles I'm taking? How does that balance the rest of my portfolio? So, like, can I see a road to 30x on this deal with a reasonable risk adjusted return based on what could happen to it? What the bear cases are? If it's a binary risk company, if you're like doing most biotech, either you're going to be a multi-billion-dollar business or you're zero, right? If you're
Mm-hmm.
doing one of those deals, you underwrite that differently than like, what I just invested in an autonomous mining business. The odds of that going to straight zero are pretty low. So the question is, who's the logical acquirer? But it's a very different set there.
Diving back into this autonomous
Yeah,
mining company you just invested in, do you ever, I don't know, I've talked to some founders where offended isn't the right word, I should say here, but when somebody comes and looks at them and says, hey, your company, yes, could it ever get to that $1 billion unicorn mark? Absolutely it can,
yeah,
but the more strategic play here is an acquisition once you reach a certain multiple. Do you ever see that on the
yeah.
VC side whenever you recommend that to one of your portfolio companies, or just if you're ever advising someone?
I I don't invest in anything that can IPO. I don't think any VC should. If you're looking at something, even as a founder, if you're looking something as getting acquired, you shouldn't do that deal. When I say I'm underwriting that differently, it's like I think that business could be a $10 billion business. Absolutely could be. I think that it's not the same as like, look, I'm trying to think of what the comp is in my own portfolio. When I invested in GPT zero, right? And this was 3.5 years ago before ChatGPT was actually a thing.
Hmm.
That business, you're underwriting that as like that's either going to be $100 billion business AI safety platform, or that's going to zero in next year. This is very different, where your cap is probably a little bit lower, where you're looking at like $10 billion cap, even if you look at mining services. Um, but your downside's capping as well. Agriculture, especially, is a sector where you look at that too, and you say like, look, this could be $1 billion business. Realistically, just based on precedent on comps, like you'll probably end up someplace else, and you'll probably end up in a different sector. You still want that upside and potential, but you're just underwriting the risk profile differently. Uh, but yeah, I don't know. If you don't think you can be $1 billion business, you shouldn't be raising venture capital dollars. There's no reason to do that.
I love it. As we're kind of getting close, Andrew, to the end of today's episode, I want to ask you a few more questions. Any companies right now that
Yeah.
you're incredibly bullish on? Obviously, you're probably going to name some of your
My
portfolio
entire
companies, but just in the
portfolio,
general public eye.
obviously.
Yes. Of
Um,
course.
yeah, no, my entire portfolio. I have Jules AI. I'm an investor in a stealth wireless spectrum company, and then Ursa Mining, which I don't think I formally announced that, but that'll go public at some point in time, probably before this podcast. So hopefully, um, very bullish there. My entire angel portfolio. I'm bullish on myself. No, if we like zoom out, look, I've been a lot of these nuclear SMR next wave nuclear. I'm pretty bullish on. I was late to that wave. Frankly speaking, I thought the regulatory environment was too risky to do those deals 5 years ago. Regulatory environment has shifted in what I believe to be a
Mm.
permanent way. I don't think the government's going to come back in and change that, even if we have a fully different office in 4 years. Um, so that's like Radiant Nuclear, Blue Energy, a bunch of those companies pretty bullish on. Base power, distributed grid, um, very excited for what's going on there too. I think if you're like looking at public deals, that's where I'm at. And then I don't know, the AI deals, I think you're starting to see it narrowed down on the field. OpenAI, I think, is at a point where you're nearly too big to fail. I wouldn't call it quite yet. Anthropic, I think, has done a great job keeping up. And then 11 Labs from a voice side, I'm pretty bullish on too. Um, so yeah, hopefully that's a good answer to that. I don't know. It's hard to think about late stage when you're an early stage investor, for sure. It's a different world out there right now, especially.
It is a completely different world. I love it. Well, Andrew, to close out today's episode of the Get Over Yourself podcast, the entire reason I started this show was to help business owners and founders and high leverage employees to go back and give more of their time and their talents and their money and give back to the community that supported
Yep.
them to get to the stages they're in, and hence get over yourself. I'm curious, from your VC perspective, how can you live the principles of getting over yourself inside of your own life to give back to those around you?
Yeah, I mean, I think it's in not forgetting where you came from and the people who helped you along the way. When I was starting in venture, I knew nothing about the industry. There were a bunch of people who took calls with me who should not have taken calls with me, like general partners at pretty credible firms. Some of those people are still really good friends to this day, and that's something I remember. And at least I try to impress on other people about the same career point that I'm at VC side. Like, look, make time for those college kids who are reaching out to you on TikTok. Make time for people who really stand out and take the time to get to know you, and that you can help along the way, because you were that person at some point in time. Venture capital is an apprenticeship business. It's not like, there are very few hard skills in this industry. It's just a lot of lived experience and then acting on that lived experience. Um, and so the extent to which you can provide that to others and the way that others provide that to you, I think, is what I would say there.
I love it. I love it. Well, everyone, thank you for listening to today's episode of the Get Over Yourself podcast. Andrew, thank you for joining us. If anyone is interested in seeing his TikTok, Instagram, LinkedIn, or any other content, I'm going to include that in the episode description as always. And Andrew, good luck with your investment thesis going forward. Best of luck in your entire journey as you're diving in. Any odds that you'll bring on any more partners in the near future? Or are you sticking solo for the time being?
Doubtful, but never say never is what I would say.
Never say never. I
It's
like that.
venture's an interesting place. You have to make decisions with the best information you have, and things change rapidly. But yeah, that's closing
I love
thoughts.
it.
Thank you for having me, man. Enjoyed the conversation.